The last example that we're going to look at in Chapter 19 is looking at costs of quality to make a quality cost report. We have 2 years of information about quality costs for a company, and we want to look at those 2 years side by side to see if we've had changes in our costs of quality. So the first thing that we want to do is we want to sort all of these costs into either prevention costs, appraisal costs, internal failure costs, or external failure costs. So we go through each item one by one. The first is warranty expense. Warranty expense is an expense that happens after our customers have their product and they've filled out the warranty on that item to have something fixed. So warranty expense is an external failure cost. Next, we have product design. In our product design, we want to have a product that doesn't have defects to begin with. So product design is a prevention cost. Our next item is scrap. Scrap is when we have defects in the product from the production process. Scrap is an internal failure cost. Process engineering. Process engineering is when we look at our processes and we redesign them to be more efficient or in order to prevent defects. So process engineering is a prevention cost. Raw materials inspections. All inspections are appraisal costs. Product liability claims. Product liability claims happen after a customer has our product, which makes product liability claims an external failure cost. Rework. Rework is an internal failure cost. That is when we had something wrong with the production, but we were able to fix it before we sent it out, where in scrap we have to throw it away. Returns resulting from defects. Sales returns happen after the customer already has it. So returns is an external failure cost. Supplier certification costs. Supplier certification is where we make sure that we have the best suppliers available so that we're getting the highest quality direct materials. So supplier certification is a prevention cost. Preventative machine maintenance. Well, that's already in the name. Preventative is a prevention cost. Final inspection costs. All inspection costs are appraisal costs. Employee training costs. Employee training makes our employees work better, so they're less likely to have rework or scrap. So employee training is a prevention cost. Equipment breakdown repair costs. Equipment breakdown is an internal failure. We didn't take good care of our equipment and it broke down. An estimate of lost sales due to quality issues. When we lose sales because of quality issues, that means that our customers are highly dissatisfied with our products and they're not coming back to us to buy more. Lost sales is an external failure cost. Now that we've identified what each of our costs is, we can add up and get our total prevention costs, total appraisal costs, total internal failure costs, and total external failure costs in year one and in year two. And if we add the sum each of our 4 types of costs, we get total quality costs for the year. So we can see that some of our costs went down and some went up. The next step is to look at our cost as a percent of sales. So we take our year one cost of $16,000 divided by year one sales. Well, what we want to know is what changes did we have in our cost of quality and how did it impact the other items that we had? Well, we can see here that we more than doubled our prevention costs from year one to year two. The effect that it had is that we dropped the amount of money we were spending on inspections. We had less breakdowns, less scrap, and less rework. And we had less returns resulting from defects and less warranty expenses. The only items that didn't go down were our product liability claims and any estimate of lost future sales. What we can see then is that there is a positive effect from spending money on prevention for defects in reducing the number of defects that can happen internally and externally. What we would want to investigate is why we still have an increase in product liability claims when all of our other numbers went down. So the managers of that company would then go look at what type of product liability claims we have and try to analyze exactly where the product is having a defect or lack of quality that is causing those issues.